Data for May for the US economy came in much better than expectations, and therefore the markets cheered up. Is there still a reason to cheer? Let's explore more. Now, if you see this chart, the economy added 22.1 million jobs since 2011, which is what this line is indicating. And if you see in March, there was a loss of 1.3 million jobs. In April, a massive decline of 20.7 million jobs, which means that all the gains that were there since 2010 and 11 all got wiped out together. However, there has been seen some rebound in the May numbers, which has come in plus 2.5 million extra additions to the employment data in May. Now look at this data extracted from Bureau of Labor Statistics unemployment numbers since 2010. And if we see this entire screen, the lowest that I can see since 2010 is somewhere around 9, between 9 to 10%. And if you see 2020 numbers, it was in April where there was a massive decline, 14.7%, and May, 13.3%. Although quite a lot of economists are saying that this number in May came in much, much better than expectations. Now, this is another interesting chart here, unemployment rate data since 1950. And if you see this chart, a lot of peaks and troughs, but there was one peak somewhere in 1984's, 83's, where it went above 10%. Then in the last recession, it was somewhere around 10%, like the way we discussed. And if you see the current numbers, it is currently hovering around 13.3%. Now, it is interesting to see where most of the rebound actually came from in May 2020. So as expected, a lot of rebound came from leisure and hospitality sector. So all the jobs that were gone temporarily with restaurants and hospitality sector closing down, there we see a huge rebound here. Then the second sector was construction, where again we see a huge rebound. So both these sectors had temporary loss of jobs, but then once the opening has started, it has been seen that the numbers have started rebounding here. Another sectors to look at: retail, it was okay, neutral. Manufacturing, education and health, business and professional services, very, very small rebound. So most of the rebound came from restaurants, hospitality, and construction. Now, this is a snapshot from Trading Economics, and it's important to compare what the market was expecting and what the numbers came out. So, if you see here, for May, the market was expecting somewhere around 19 to 20% for the unemployment numbers, where the numbers actually came in out at around 13%. Now, how do we view this rebound in unemployment rate data? So, there are a number of caveats here. Number one, the unemployment rate in hospitality sector is currently still at a whopping 35%. And remember, the rebound is primarily due to the restaurants and hospitality sector again hiring these people. Now, if the number of cases spike up, there might be a situation wherein these people again go out of employment. Secondly, a lot of people actually gave up looking for work, and therefore they are not counted in the unemployment data. Again, that makes the data which comes out to be lower than what actually it is. Also, for the last few months, the Department of Labor has identified that the people are not filling up the survey very correctly. They are getting confused with the questions like whether they are unemployed due to family situation, vacations, etc., or they are unemployment due to coronavirus or a contingency situation. Unemployment rate has been welcomed by the markets. However, considering that this pace continues, it would take almost a year to reach to a level where we were once a year back.